Today, from here, where for the markets? Hello again, it's Martin North from Digital Finance Analytics World, and this post covering finance and property news. And this is our weekly market update where we start in the US, cross to Europe and Asia, and end in Australia. We cover commodities and crypto along the way. And as this is the last full trading week of the year, we'll also look back at the full 12 months. Now, there's a nice meme going around highlighting that high-priced stocks attract, others do not. But it does also beg the question, should we follow the crowd? And is that where the smart money or the dumb money lurks? Sometimes it's better to zig when everyone else zags. Anyway, the MSCI Global Index was down 0.59% on Friday, though up 0.88% across the week, and the one-year return was 17.14%. And as we will see, that was driven by tech and US markets in the main. Remember, though, that light trading and short hours means that the markets are capable of giving deceptive signals this past week. US stocks wrapped up the Christmas week on Friday with retracements of double-digit uptrends, and alongside the dollar, to a smaller degree, succumbed to profit-taking in illiquid markets ahead of the last weekend of 2024. So far this month, the US share market has lost some of its gains since President-elect Donald Trump's election win, which raised hopes of faster economic growth and more lax regulations that would boost corporate profits. Worries have risen that Trump's preference for tariffs and other policies could lead to higher inflation, a bigger US government debt pile, and difficulties for global trade. Even so, the US market remains on pace to deliver strong returns for 2024. The benchmark S&P 500 is up by 25.18% so far this year and remains near its most recent record high. That was set earlier in December, which was its 57th record high. And US markets have historically had a boost at the year's end, despite lower trading volumes. In fact, the past 5 trading days of each year, plus the first 2 of the new year, have brought an average gain of 1.3% since 1950. Leading the declines were high-flying Magnificent 7 stocks like Tesla, which slid 4.9%, along with Amazon, Microsoft, and Nvidia. The S&P fell 1.11%, leaving Wall Street's benchmark with a 0.67% weekly gain. The Nasdaq Composite ended down 1.49%, having been down more than 2% during the session, and the Dow Jones Industrial Average fell 0.77%. For 2024, the Dow is up 14%, and the tech-heavy Nasdaq is up 31.38%, and the VIX, by the way, was at 16.94%, up more than 20% from a year ago, perhaps signaling greater uncertainty out there at the moment. This exceptional performance of the S&P 500 is largely due to the Magnificent 7, whose gigantic market capitalization and strong growth have dominated the market. Apple was up 30.9% year-to-date, Microsoft up 74.8%, Alphabet, Google up 26.2%, Amazon up 45.5%, Nvidia up 201.3%, Meta Platforms up 77.2%, and Tesla up 44.1%. Without that contribution, actually the S&P 500 returns would have been much closer to the average, still respectable, but far less remarkable. A labour market update also showed that US applications for unemployment benefits held steady last week, though continuing claims rose to the highest level in 3 years, according to the official figures. Fed Chair Jerome Powell said earlier this month that US central bank officials are going to be cautious about further cuts after an as-expected quarter-point rate reduction happened. The US economy also faces the impact of Donald Trump, who has proposed deregulation, tax cuts, tariff hikes, and tighter immigration policies that economists view as both pro-growth and inflationary. Higher US rate expectations lifted the 10-year Treasury yield. That rises as the price of the fixed income instrument falls to its highest level since early May On Thursday, it reached 4.641%, but it was last at 4.627%. The 2-year was at 4.32%. Traders are pricing in just a 37 basis point of US rate cuts in 2025, with no reduction fully priced in until May, by which time the ECB is expected to have lowered its deposit rate by a full percentage point to 2% as the Eurozone economy continues to slow. Wall Street has several economic reports to look forward to next week, including updates on pending home sales and home prices, a report on US construction spending, and snapshots of manufacturing activity. Even with its slight loss on Friday, the US dollar has headed for an almost 7% annual gain as traders anticipated robust US growth, as well as tax cuts, tariffs, and deregulation by the incoming administration of President-elect Donald Trump. And that would make the Federal Reserve a little cautious on rate cutting into 2025. The dollar index, which measures the currency against 6 other major currencies, eased 0.06%, with a 0.2% weekly gain, and still shows a 6.6% gain through 2024. With just a month to go to Trump's inauguration, speculation is mounting about what policies he will prioritize in his first few months in office. The recent debacle with the spending bill, when the government came close to shutting down, suggests that not all Republicans are on board with Trump's fiscal ideology. Meanwhile, Trump has also already upped the ante when it comes to tariffs, threatening Australia's allies, Canada, Mexico, and the European Union with higher levies. Any developments on tariffs or fiscal policy during a holiday lull, when trading volumes tend to be extremely thin, could bring about some big spikes in Treasury yields, which would then have ripple effects in the foreign exchange and equity markets. Gold futures prices dipped 0.74% to $2,631.90 per ounce, which is still set for a 27% rise for the year and the strongest yearly performance since 2011, as geopolitical and inflationary concerns boosted the haven asset. Trading in gold typically sees thin volumes and subdued prices towards the end of the year, as many institutional traders and market participants close their books ahead of the holiday season. A weaker dollar often boosts gold prices as it makes the yellow metal more attractive to buyers using other currencies. Of course, the reverse is also true. Silver, the white metal, delivered its own impressive rally. The price surged from $22 an ounce at the start of the year to over $32, marking its first breakthrough of this level since 2012. This strong performance was driven by robust industrial demand, particularly from the renewable energy and electronics sectors, as well as increased investment interest amid geopolitical tensions. It was last $29.96 on the futures contract. Oil prices have remained under pressure this year. While rising tensions in the Middle East briefly fueled price volatility earlier, concerns gradually shifted from political supply disruptions to the broader weakness in global demand. This past week, oil prices firmed as investors awaited news of economic stimulus efforts in China, the world's biggest crude importer. Brent crude futures rose 0.67% on the day to $73.62 a barrel and is up 1.14% for the week, but down 3.56% over the year. WTI was also up to $70.60. That's up 1.41% on Friday, but down 1.47% across the year. So on an annual round trip to nowhere. On the other hand, global debt increased by over $12 trillion in the first 3 quarters of 2024, reaching a record $322.9 trillion. The global debt to GDP ratio fell to 326%, about 30 percentage points below the 2021 record, but remains well above pre-pandemic levels. The US budget deficit expanded to $1.8 trillion in fiscal year 2024. That's the highest level outside the COVID-19 era. Since the end of the debt ceiling crisis in June 2023, total US debt has increased by $4 trillion. In other words, the US has taken on an average of $325 billion in debt per month, or $8 billion per day, since June 2023. This surge was driven by federal debt interest payments, alongside increased spending on Social Security, healthcare, and the military. So all up, the Santa Claus rally is one of those historic statistics that bears watching, but because of the change in administration and the potential change in policy, you're probably seeing more action now than you would normally. And there's the potential for a lot more disruption through 2025. Goldman Sachs expects 2025 to be another challenging year for the European economies. The Wall Street firm said on Friday that Europe faced intensified economic headwinds. After a near recession in 2023, economic growth had resumed in early 2024 with a pickup in household consumption and exports. Unfortunately, this encouraging dynamic has rapidly lost momentum. The Eurozone's third quarter GDP showed a modest 0.4% growth, exceeding the 0.2% forecast, and most economic indicators have disappointed expectations. This is due to a succession of adverse developments since 2022. Sanctions against Russia following Ukraine's invasion, the ensuing cut from Russian gas supply, weaker Chinese demand for manufacturing goods, a surge in inflation, and subsequent sharp rises in interest rates. These factors have affected Germany most due to the structure of its economy. Meanwhile, France is grappling with political paralysis and budget deficit challenges. Southern European economies have been less affected by recent changes and benefiting from resilient services demand, particularly from tourism. Europe's stock 600 rose 0.67% on Friday and was about 1% higher for the week and 5.88% for the year. Massive differences, of course, there to the US performance. Goldman projects the euro area will see growth of 0.8% and the UK 1% in 2025, both figures falling below the consensus. The labour market in the euro area has shown more resilience than anticipated this year, according to the bank, but wage growth has decelerated as pay adjustments align with past price increases. Underlying inflation also cooled significantly post-summer, prompting the ECB to cut policy rates by 100 basis points over the year. Goldman strategists anticipate further 25 basis point reductions sequentially to 1.75% by next July, with the possibility of more aggressive cuts if economic conditions continue to deteriorate beyond expectations. In contrast, the UK has experienced persistently high wages growth and services inflation, leading the Bank of England to adopt a more cautious stance than other major central banks. The Bank of England has reduced the bank rate only twice this year, with Goldman Sachs expecting additional quarterly rate cuts throughout 2025 as a weaker labour market cools underlying inflation more than currently priced, the report said. On Friday, UK's FTSE closed up 0.16% and was 5.39% higher across the year. German stocks were mixed as gains in the food and beverages, software and technology sectors led shares higher, while losses in the construction, retail and basic resources sectors led shares lower. At the close in Frankfurt, the DAX rose 0.68% and was up 19.3% for the year. France's CAC 40 rose 1% on Friday, but was down 2.49% across the year, highlighting the impact of political instability and poor economic performance to boot. Most Asian stocks were higher on Friday, with Japanese shares surging after a stronger than expected Tokyo inflation reading, while South Korean shares slumped amid ongoing political unrest in the country. Japan's Nikkei 225 index jumped 1.77%, hit a new 3-month high on Friday, and was up 4.07% for the week and 20.36% for the year. The Topix rose 1.26% on Friday and was up 18.39% higher across the year. Japanese equities were boosted by gains in Toyota Motor Corp and other auto shares amid a weaker yen. The US dollar, Japanese yen, was down 0.15% to 157.77. Japan's factory output fell for the first time in 3 months in November due to softening overseas demand, although contracted at a slower than expected pace from the previous month, according to government data. Industrial output also fell 2.3% in November from the previous month, according to data released on Monday, and that missed median market forecasts for a 3.4% fall compared to a 2.8% rise in October. Separate data also show that Japanese retail sales rose 2.8% in November from a year earlier, beating expectations for growth of 1.5%. The Bank of Japan is expected to hike its policy rate by 25 basis points at an upcoming meeting in January after it kept rates unchanged this month. Earlier this week, the governor said that the economy is expected to make progress towards sustainably reaching the central bank's 2% inflation target next year, hinting that an interest rate hike could be approaching. Consumer price index data in Japan's capital grew more than expected in December due to increased price pressures, according to government data, and that kept alive chances of a near-term rate hike by the Bank of Japan. In fact, some Bank of Japan policymakers saw conditions aligning for a near-term rate hike, with one predicting action in the near future, according to a summary of opinions from December's meeting. Over in China, industrial profits fell at a reduced pace in November, according to official data released on Friday, offering some relief to the struggling sector, though weak domestic demand continues to hamper recovery efforts. Of course, this year the government unleashed a series of bazooka stimulus measures to stabilise its economy, aiming to address the ongoing real estate crisis and stimulate consumption. Initiatives included permitting local governments to use special bonds for purchasing land from troubled developers and hinting at upcoming debt ceiling adjustments. While the impact remains to be seen, those policy shifts suggest a potential for recovery in 2025 if fiscal and monetary easing continues. The announcement of those stimulus measures had an immediate positive impact on Chinese equities. The CSI 300 index, which tracks the largest stocks listed in Shanghai and Shenzhen, surged 4.3% on the day of the announcement, marking its best performance since March 2022. However, this initial enthusiasm was short-lived. By the end of the year, the index has relinquished a significant portion of earlier gains as investors reassess the effectiveness of the stimulus measures. In fact, the World Bank raised its forecast for Chinese economic growth, projecting GDP expansion of 4.9% in 24 and 4.5% in 2025. The revisions announced on Thursday reflected improved export strength and recent policy easing aimed at stabilising the economy, including measures to support the property sector and consumer spending. Despite the outlook revision, challenges persist, with the World Bank noting that weak household confidence, high local government debt, and a prolonged property downturn continues to weigh on economic activity. China's property market, a traditional driver of growth, is unlikely to recover until late 2025, according to the bank. Measures such as liquidity support for developers, reducing housing down payments, and state pushes of excessive housing inventory have been introduced to mitigate the impact. China's Shanghai Shenzhen CSI 300 and Shanghai Commodity indices rose 0.4% and 0.3% respectively on Friday. Hong Kong's Hang Seng index was 0.2% higher for the year. The CSI 300 was up 16.03%, while the composite was at 14.2% higher, and the Hang Seng was 17.85% up. South Korea's Kospi fell over 1% on Friday. That's the third consecutive session of declines. South Korea's acting president, Prime Minister Han Duck-soo, faced an impeachment vote on Friday amid a political crisis sparked by the Constitutional Court's first hearing on President Yoon Suk-yeol's short-lived martial law. The push to impeach Han has deepened the crisis, placing the nation's democracy in uncertain waters and drawing concerns from allies. The index is actually down 9.43% across the year, reflecting those concerns. India's stocks were higher on Friday at the close, as gains in the auto, IT and banking sectors led shares higher. Nifty 50 added 0.35% and is up 9.58% across the year. In Australia, a rally in consumer discretionary and major bank stocks helped Australian shares on Friday extend their rebound on the first day of trading after the two-day Christmas break. The ASX 200 added 40.9 points or 0.5% to 8,261 at the closing bell on Friday, when 8 out of 11 sectors climbed. The All Ords gained 0.6%. For the year, the ASX 200 is up 8.84%, so a pale reflection of the US markets. On the day, the consumer discretion sector was the best performed, with Aristocrat Leisure up 1% to $69.47, and that's up 70.19% for the year. Breville jumped 2% to $36.22, and Wesfarmers added 1.4% to $72.56. All the major banks were in the green, led by Commonwealth Bank, up 0.7% to $156.21, and CBA is up 39.72% for the year. Westpac rose 0.7% to $30.66, and they're up 43.39% for the year. National Australia Bank increased 0.5% to $37.58, but is up just a 22.41% for the year. and ANZ firmed 0.3% to 28.82, up only 11.19% for the year. So not all banks are equal. Macquarie was up 0.82% on Friday and up 22.5% for the year. The return to trading consolidates Monday's rally when the benchmark surged 1.7% for its best day in 6 months after a bout of heavy selling in the previous week. Shares are headed for an 8.9% annual return before dividends. Brighter prospects for global growth and tamer inflation should lift Australian shares to record-breaking territory in 2025. But unlike the thunderous rallies of 2024, future gains will come with greater volatility and more uncertainty. Equity strategists predict shares are set to capitalise on easier monetary settings, improved business sentiment, and household rate relief. So it does depend on when rate cuts start. As the bull market heads into its third year, investors will face steeper and more frequent sell-offs as lofty valuations are tested by protectionist tariffs, the strength of the US dollar, and the maturing of AI megatrends. Australia will be one of the last advanced economies to witness falling interest rates, as the Reserve Bank's confidence that high inflation has been slayed gives it room to lower the 4.35% cash rate. Of course, the Bank of England, US Federal Reserve, and the Reserve Bank of New Zealand are all into their second or third interest rate cuts through 2024, and the European Central Bank cut rates 4 times. Financial markets imply a 54% chance of the RBA easing rates at its first board meeting in February 2025, and there's a 100% chance by April. We'll see about that. AMP's head of investment strategy, Shane Oliver, is warning of a volatile ride. Given the share market stretched valuations, the ASX 200 is trading at more than 18 times forecast earnings, and heightened geopolitical risk as Donald Trump returns to the White House. Still, Dr. Oliver is tipping the ASX 200 to achieve 8,800 points. He said the prospect of better growth in late 2025 should deliver okay investment returns, with a caveat that a 15% market correction during the year was highly likely. However, JP Morgan's Jason Steed is adopting a bearish footing, tipping Australia to be the only major share market to decline in 2025. His target of 7,900 implies a decline of about 6% from current levels because of a weaker economic backdrop, with gross domestic product below 2% and a softening earnings outlook. Finally, in crypto, the overall cryptocurrency market capitalization approached $3.8 trillion, nearly doubling over the past year. To the surprise of many, 11 Bitcoin spot ETFs were approved by the SEC early in January. Since launch, they've attracted more than $40 billion net inflows, and their accumulated assets under management almost as large as those held by the gold ETFs. Bitcoin surpassed the $100,000 mark for the first time, up over 132% since the beginning of the year, though it's now back at 94,857 at the time of writing. This surge was largely attributed to the election of President Donald Trump. For the first time ever, the US will have a crypto-friendly White House, as more than 300 congressmen and senators are favorable to digital assets. As institutional adoption and regulation are on the rise, the entire crypto ecosystem is gaining some recognition and momentum. Since the beginning of the year, Ethereum has risen by 67%, Solana by 119%, and Ripple XRP by 277%. Although just be careful, as not all coins are at new highs thanks to volatility. Doge, though, does take the biscuit. Additionally, the share price of MicroStrategy climbed by approximately 492% year to date, thanks to its Bitcoin accumulation strategy. So looking ahead to 2025, an especially complex and uncertain future awaits. Expects a reacceleration of US inflation, which will cause the Fed to pause more cuts, and add in the possibility of serious geopolitical shocks, and it's easy to get anxious. Possibly the RBA will hold off from cutting rates as inflation still haunts across Australia too. And the future is complicated by the advent of the new Trump regime, which renders so many different potential paths and possibly some false signals. The partnership between Trump and Elon Musk could be key if that relationship survives. But given the stretched market valuations and rising inflation risks as global debt expands further, perhaps it's not that surprising that some are taking profits and waiting to see what happens next. Time, of course, will tell. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.